It is a pleasure to introduce our next instructor based in Mumbai, India. Lalaram Singh is the CIO at Vibrant Securities, managing the proprietary book based on long-only value investing principles. Vibrant Securities is a 20-plus-year-old stockbroking company based in Mumbai. Previously, Lalaram was the co-founder of AnalyzeWise Investment Advisors, an independent equity research company catering to retail institutions and brokers. Before that, Lalaram was part of a 12-member team at Bain Capital at their Mumbai office, where he evaluated investment opportunities across industries ranging from healthcare, IT, industrials, and consumer goods. Lalaram began his career at JP Morgan upon completing his bachelor's in mechanical engineering from Mumbai University. On behalf of the MOI Global membership community, a very warm welcome back to this forum. Lalaram, please go ahead.
Thanks, John, for giving the opportunity. It's a pleasure to address all the members of MOI for the second consecutive year. And thanks, John, for giving me this opportunity. This year, I'm going to talk about a company based out of India, which is called as KDDL. The company is relatively small in size with a market cap of approximately $70 million. But we believe that this company has the potential to scale up to 3 to 4 times from its current size based on the businesses in which it is present, which offer huge scope for future growth and scalability. The company is in the sector, is into luxury and premium watch component manufacturing and retailing sector. This is the basic flow of my presentation. I'll give a brief overview of the business, followed by a short thesis, investment thesis. Then I'll deep dive into the two different businesses of this company. One is manufacturing business, primarily components for premium and luxury watches. And the second business is retail, which is more India focused. So I will deep dive into that business as well. And then I'll wrap up with how our company is positioned to benefit in the growth of the market in both of these industries, and what we believe this company can look like in the next 3 to 4 years in terms of its revenue scale, profitability, and valuation, obviously followed by the key risk factors. So without much ado, I'll move forward with the business overview. This company was founded in 1981 as Kamala Dials and Devices Limited, shortly in short form called as KDDL. It is promoted by Mr. Sabu, who is the CEO as well, and a pass out of one of the premier institute of India, IIM Ahmedabad. This company started with manufacturing of watch dials, catering to the Indian markets to begin with. However, today almost 70% of its business comes from export to Swiss watch brands. Apart from watch dials, subsequently this company entered into manufacturing of hands for Swiss brands. The latest business within manufacturing is manufacturing of components for non-watch applications like metal stampings, plastic injection moldings, and assemblies for applications in electrical electronic appliances, in transportation, in aerospace applications, etc. This is a relatively new business and expected to be the growth engine going forward. In 2003, KDDL started to retail luxury watches in India, trying to leverage its manufacturing relationship with the Swiss brands. In 2003, the market itself was relatively small for luxury watches in India, and therefore there was no serious pan-India player. And the idea of the company was to enter this market in its infant stage and create a pan-India chain of luxury watch retailing within India as the market grows with time. And today we are the largest retailer of luxury watches in India with around 15% market share, and we are the only one which is pan India. Uh, while most of the competitors are limited to 2 or 3 cities and run by family business family by families, this is a professional company which has been able to create a pan India franchisee in luxury watch retailing. As far as overall revenue numbers for this company is concerned, KDDL has, for calendar year 2018, has revenues of around $87 million, an EBITDA of $9 million, and a PAT of around $4 million. These are consolidated numbers, and it trades at around 9.4 times LTM EBITDA and 19 times trailing earnings. This is the short, brief summary of the business structure. The manufacturing is around 28% of the business. However, in terms of profitability, it contributes significantly to the overall company. Retail business, while contributing to 72% of revenues, still is subscale in terms of profitability, as we can see that the PAT of this business is only $1.7 million, while manufacturing, in spite of being only 30% of the business, delivers more than $2 million of PAT. We believe going forward, as retail business scales up, the true profitability of the business will emerge, as the business currently is in an investment mode. Within manufacturing, as I said, we have the biggest part is watch hand and dial manufacturing, which is almost 3/4 of the business, and then there is 1/4 is precision engineering, which is nothing but component manufacturing for non-watch applications. I would now like to just yeah, there was some issue with the slide change. Yeah. So thesis of this company, the thesis is that on one hand, we have a very stable manufacturing business which caters to mostly Swiss watch manufacturers. This business enjoys extremely high gross margins, almost 75%, and delivers around 15 to 20% pre-tax ROCE with a strong cash conversion of 75%. The unique thing about this business is that we are only one of the 5 non-captive manufacturers of hands for Swiss watches. This business comes with strong competitive advantages in the form of very critical components for our end users because of the quality. At the same time, because of the low value of the product, typically watch hands and dials contribute around 3 to 4% of the overall value of the watches. Therefore, what the watch manufacturers, the watch brands generally don't like to switch their suppliers too often. In the manufacturing business, the watch business has been growing at more than 7 to 8% historically, compared to the Swiss market growth of 3 to 4%, which implies that we have been gaining market share because of our good quality supplied at a very cost competitive level compared to global suppliers. However, watch component manufacturing will not grow more than 7, 8, 10% per year. This is where the new business within manufacturing, which is precision engineering, is going to provide the growth engine for us, because this business as of today is only $5 to $6 million in size. However, it is growing at more than 25% per year and has a considerably larger total addressable market compared to the watch hands and dials for Swiss brands. We expect the manufacturing business to grow at more than 15% overall in the next 4 years and deliver a revenue and profit of around $44 million and $4 million respectively. Uh, as far as the watch retail business is concerned, the current Indian market for Swiss watch imports is around $156 million, which compares significantly lower compared to economies of similar size like Italy, uh, UK, France, which have a market size of around 1 to 1.3 billion dollars, which means that we should be at least 5 to 6 times bigger in terms of the market for Swiss watches in the coming future, which will be driven by obviously the increase in GDP per capita, because India is still relatively a poor country compared to some of these top markets for Swiss watches. But we believe that in the next 10, 15 years, India should definitely be a 5 to 6 times bigger market for Swiss watches than today. And Ethos, which is the entity through which we retail Swiss watches in India, being the largest player in India, should automatically benefit from this growth in the market. At the same time, we believe that we will be doing much better than the market because of the different positioning which we have created, which I would explain in the presentation going forward. We believe Ethos, which today has $60 million of revenues, can scale up to around 120 to $150 million in the next 4 years, which will be mostly driven by the growth in the market itself, with additional benefits coming from the increase in market share. And well-run, well-managed retail businesses in India are trading at a significant premium to the overall markets, at around 2 to 4 times revenues. And we can debate whether these multiples are justifiable in an absolute sense, but as of today, retail businesses in India are getting these multiples. So in the next 3 to 4 years, we believe that Ethos can command a market cap of around $200 million. And today, KTDL as a whole is available to us uh, at $70 million. So overall, I believe that there is a potential to for this company to be 3 to 4 times its current market value, which will be mostly driven by the value of the retail business. And the management has already announced a spin-off of the retail business. Currently, it is a subsidiary which is owned 72% by us. Going forward, the management wants to list this subsidiary, retail subsidiary, into an independent listed entity, and that will unlock the true value of this retail business. Now, I would like to spend some time in the manufacturing business, which is into watch parts and precision engineering. So the overall manufacturing business, the bigger pie is the watch component manufacturing, which is around 75%, and is involved in the manufacturing of hands and dies for watches. Out of which 70% is exports, mostly to Swiss brands, and 30% is domestic business supplying to players like Titan and Timex in India. This business for the last 5 years has grown at around 6% per annum. The smaller part of the business is precision engineering, which mostly deals with metal stampings, plastic injection molds, and other precision engineering components, which find applications in industries like aerospace, electrical equipments, electronics, and healthcare equipments. This business is small as of now, only $5.5 million. However, it has grown at 19% over the last 5 years and 20% plus over the last 3 years. This business is expected to be the growth engine for the overall manufacturing business, while watch manufacturing is expected to be a stable cash generating business growing at 7 to 8% per year. Now, the market opportunity for the watch manufacturing business. As I said, the 70% of the watch manufacturing business is exports to Switzerland. Switzerland total watch exports market as of today is $22 billion, out of which Around 4 to 5% of that is the market for hands and dials, which comes to around $1 billion. And most of that is produced captively by the Swiss manufacturers, almost 80%, which means that only 20% of the market for watch hands and dials is left for non-captive producers like KDDI. We estimate that the non-captive market as of today is $200 million, and KDDL commands a market share of 5 to 6% with revenues of around $11 million. Going forward, the key growth drivers for this business would be shift of production from captive to non-captive players as competitive intensity among the Swiss brands increases, leading them to increase their focus on cost optimization. At the same time, we believe KDDL will increase its market share within non-captive players as it has done historically, and therefore might grow faster than the overall market. Now, I would like to spend some time on the characteristics of the watch component business. As I said, for KDDL, around $18 million of the manufacturing revenues come from hands and dials, and it is split equally between the two, which means $9 million each come from hands and dials. 70% is of the sales come from exports to Switzerland, and therefore the revenues are closely linked to the Swiss export market. The business is highly specialized with gross margins of 70% plus, and particularly hands manufacturing is more specialized compared to dials. It is important to note that we are one of the only 5 non-captive hands manufacturers for Swiss watches globally, and the only one from India. We supply almost 98% of the hands requirement for the number one manufacturer of watches in India, which is Titan, which explains the market positioning of KDDL. The return on capital for this business is between 15 to 20% for the last 5 to 6 years. Therefore, this business delivers a decent return on capital, which is almost twice the cost of capital in India, which is around 9 to 10%. Now, let us see the market positioning of KDDL in hands and dial manufacturing. As I said, our market share as of today is around 5 to 6% in the Swiss hands and dials industry. We are only one of the 5 non-captive manufacturers globally. And if you look at the growth in our exports to Switzerland, the hands and dials parts, we have grown for the last 15 years at the rate of 9%, adjusted for currency depreciation, compared to Swiss watch exports growth of 5%. And even for the last 8 years, we have grown at 11% compared to 3% for the Swiss watch exports, which means that we have consistently grown at between 4 to 8% higher rate than the overall Swiss exports of watches, indicating market share gains. We believe that we will continue growing faster in the market. At the same time, we have recently acquired a Switzerland-based non-captive hands manufacturer called Estima, which will enable us to supply to more premium brands who prefer sourcing their material from Switzerland. So Estima was acquired recently in Jan 2019. It's a Swiss-based watch hands manufacturer, a non-captive manufacturer. We acquired for $2 million. At the peak, this company was generating $20 million of revenues, but today it is only doing $2 million because of its inability to adapt to the changing industry dynamics, combined with a lack of strong leadership at the top, as the existing family didn't have any future management in place. The rationale for this acquisition was to build relationships with high-end Swiss brands that prefer sourcing 100% from Switzerland, and also increase wallet share with current customers. And according to the management, they can scale Estima's revenues almost 5x to $10 million in the next 5 years. This will be a key monitorable for us. For the non-watch manufacturing business, which is precision engineering, this started as the tooling division for the watch manufacturing business. However, over time we started employing this for non-watch applications as well, using plastic as well as metal as the underlying material. The key products are metal stampings, plastic injection moldings, sub-assemblies in this segment. End user industries: aerospace, automobile, defense, medicine. Some of the clients include ABB, Siemens, Tyco, L&T. This business is almost one-fourth of the manufacturing business and is expected to grow at 25% plus based on the new client wins and more marketing which is being done at this segment level, where we are attending global events and showcasing our product capabilities. We expect this to be the growth engine for the manufacturing business going forward. As far as margins are concerned, it delivers similar margins compared to the watch manufacturing at around 18%. Now, the key financials for the manufacturing business: it has grown as of today, as of FY18, which is ending March 18 for India. It's a $21 million business, has grown at 8%, 9% over the last 5 years. Current PAT is around $2 million. For the calendar year 2018, which means December 18, the PAT is around $2.2 million. EBITDA margin consistently at around 18%. And if you look at the return ratios, this business delivers 15 to 20% return on capital consistently, and with operating margins of EBIT margins of 13 to 14%. The outlook for this business, for the manufacturing business, we believe that this business overall can grow at a 15% CAGR over the next 4 years, driven by 7% growth in the watch component manufacturing, 26% growth in the Estima, the acquired business. We expect that it can reach from current $2 million to $5 million in the next 4 years. While the management has guided for $10 million, we have remained conservative. The precision engineering business, which is called as IGEN, is expected to grow at 20%. And assuming the margin structure to remain same, the profit after tax will also grow at around 15% in the next 4 years, which means that in our base case, we expect the manufacturing business to deliver a PAT of around $4 million. And once independently listed, once it is separated from the retail business, we believe it can get a multiple of around 15 times, in line with other companies within India which exhibit niche characteristics with sustainable return on capital and relatively strong entry barriers. They get 50 to 20 times multiple in India. We believe that 15 times is a fair assumption, and therefore this manufacturing business itself can be worth around $60 million in the next 4 years. Now we move towards the premium and luxury watch retailing business, which is done under the entity Ethos. Before that, just a small quick overview of the global Swiss watch market. The total Swiss watch exports as of calendar year 2018 was around $22 billion. And this market has grown at 5% over the last 15 years, although the growth has been subdued over the recent past. In terms of the key markets for Swiss watches, we can see that these are top markets for the Swiss watches, beginning with Hong Kong, which is more like a trading hub, therefore is not exactly consumed internally, But most of the top markets, be it USA, China, Japan, UK, Germany, we can see that their ranking in terms of, these are also economies which are the biggest in size globally. Therefore, there's a strong correlation between the markets for Swiss watches versus the size of those particular economies. The key takeaway here is that among the top 30 watches for the Swiss watches, there are only four countries which are not included in this list, while the economies of those countries are relatively big, and these are Brazil, Indonesia, Poland, Nigeria, and Argentina. The reasons vary significantly. For example, Brazil, the reason for a lack of Swiss market is the un, is the tax structure is not favorable. Therefore, the Brazilians like to shop abroad, while Indonesia is still a poor country, and Argentina again is relatively, there are tax issues, as well as it's not a very stable country, so people prefer to consume outside the nation. One of the starking facts of this list is that India, while being the seventh largest economy in terms of nominal terms, is ranked only 24th in terms of Swiss watch exports, with the exports of only 155 million uh, Swiss francs. We believe that this is a huge discrepancy, and in the coming 5 to 10 years, India, based on the demographics, based on the increase in the purchasing power, GDP per capita, we believe that the market size for Swiss watches in India should inch closer to economies of comparable size, and which means the exports should be around 1 to 1.5 billion Swiss francs in the next 10 to 15 years, as the per capita income increases and discretionary expenditure increases in India. In terms of the market opportunity, as I mentioned, um, the market today is significantly small at 150 million francs compared to the comparable economies. Um, and one of the reasons for this is that still Indians prefer to shop abroad because of a perception of lower pricing, although it is true for certain models. But as of today, the pricing for watches is in India compared to global markets is very comparable. At the same time, historically, because India was a small market, many brands were not uh, keeping all their models in India, which was an incentive for people to shop abroad. However, it has changed significantly now, and going forward, as more and more watches are available and all the brands are available in India, I think there is a case to be made for a significant jump for consumption of watches within India. Also, if we compare the market size of Swiss watches as a per HNI, high net worth individual, we see that the median market size per HNI is around $1 million. If we take uh, China, USA, Japan, Germany, UK, these are the countries for which we could gather the figures for HNI. And if we believe these figures, then India, which has a HNI population of 263,000 as of 2017, this is a report by Cap Gemini. We believe that the Indian market should be, for Swiss watches, should be around $300 million as of today, compared to a reported market size of around 150. So, which shows the underpenetration of the market as of today. This is a growth of Swiss watch exports for for a few countries between 2000 2015, and we can see that China grew at a staggering pace of 25% between that period. And only time will tell whether India can replicate anywhere closer to this. And even if India manages to grow at 15% per annum, the market will grow almost 4x in the next 10 years. And we believe that it is highly likely that India will grow at least 15% per year. Moving on to the characteristics of luxury watch retail market in India, the number one is that this market is highly fragmented, as each city within India has a prominent retailer, which is a legacy business run by a family. However, there's no one which is pan India except Ethos, and this was the primary um, primary argument on which this business was built by the promoter. Secondly, we have a significant unauthorized imports of Swiss watches, which don't get reported in the official figures. The recent onset of GST in India, the goods and service tax, was expected to reduce the unauthorized imports. However, based on our market understanding and primary research, there is still significant imports happening. Third, as I explained, Indians have a tendency to shop abroad. However, as we believe that going forward, the Indian market becomes a focus for the Swiss brands, we will be having the wide bouquet of models available, including the exclusive models which are launched by these brands in India also, and therefore the incentive to shop abroad should reduce going forward. Coming down to the overview of Ethos, which is our retail business. As I said, it is the largest retailer of premium and luxury watches in India, with a market share of around 14%. Uh, According to estimate, the Indian market for premium and luxury watches today is around $400 million, which is and just to note that this figure is different from the Swiss watch imports, which is $150 million, and the difference is primarily on account of three reasons. One is some of the Swiss watches in India are imported from trading hubs like Hong Kong, Singapore, and Dubai. Second, there are unauthorized imports which happen, and third is the import of luxury watches from non-Swiss countries like Italy, US, and Germany. Ethos, as of today, has around 47 stores, of which there are three categories of stores. One is called Ethos Watch Boutiques, which carries watches across all price points. Second is Ethos Summit, which is more premium and normally carries watches in luxury category, which means above $3,000 price points. We have six such stores. And then third is the mono brand stores, which are watch boutiques dedicated to individual brands like Rolex, Panerai, Oris, Rado, Omega. We have 12 such stores. This is the network of stores, and as we can see, we are almost present all across India. These are the brand bouquet of Ethos by different price ranges. We are almost 60 plus brands, and we carry almost all the brands. One of the brands is missing, which is Patek Philippe. We believe because it is still not present in India. We believe that once Patek Philippe launches itself in India, it could significantly increase the market size due to the strong pull of the brand. As expected, the top brand for Ethos contributes 20% of the revenues, and top five contribute 50% of the revenues. This ratio is in line with the global trends for Swiss watches. However, Ethos is looking to focus beyond the top Swiss brands and trying to bring niche Swiss brands to India on an exclusive basis, like Oris. The economics of Ethos store. Typically, these stores break even at the second year of operations, and they generate 80 to 20% return on capital upon maturity with EBITDA margins of 9 to 10%. These stores are typically 1,000 square feet in size. Major investment is in the form of inventory, followed by the furnishings. Typical gross margins for in this business is 22 to 24%, and for the main brands. Now I want to focus on how Ethos is positioned in the Indian luxury watch market. This is the yearly growth trend for Ethos, and we can see that except for 17 and 18, Ethos was growing at more than 25% plus consistently till there were some disruptions in the market in FY17 and 18, which include demonetization, which include measures like showing issuing your PAN card compulsorily for purchases above 2 lakh. PAN card is a unique number, a card which is used to file your income tax in India. And third, any purchases above 2 lakh, that is INR zero point 0.2 million, was had to be made only through either online or check. No cash was allowed. So all these things had a negative sentiment in India. However, things have normalized now as the market, as the customers have got used to the new regulations, and we can see that in calendar year 2018, Ethos grew at a staggering 29%, and we believe that with the stabilization of the regulatory environment, Ethos should again go back to its historical growth trajectory of 25% plus. Another interesting observation is that if we compare Ethos with other retailers like John Watch Company, Kapoor Watch Company, we can see that over the last 4 years, while these retailers have hardly grown or have mostly degrown their revenues, we have grown at double-digit rate. Particularly if we see the 17 and 18 period where there was strong regulatory headwinds, this is the time where the resiliency of the business model of Ethos came into the picture, because and we can see that we could grow during this time also while these retailers were struggling. Currently, we are present in 17 cities across India with 47 stores, and the management wants to expand it to 70 in the next 3 to 4 years in the anticipation of strong demand outlook. And some of these stores would be almost 4 to 5 times the current stores, as the company wants to create create a huge a customer experience, basic anchor stores in each of the countries, which would act as not just a buying destination but also an experiential uh, act as experience for the customers, which is still not in India. The luxury market is still in nascent stage, and we believe that such measures can only increase the affinity of consumers to consume digital products. Sorry, luxury products. Ethos wants to increase its gross billings to $150 million in the next 4 years compared to 71 today, reach 10% EBITDA margin, and reach a turnover of 6 months in terms of inventory, and 20% ROCE. We believe that these are highly possible based on the kind of operational capabilities which we have created over the last 15 years, which I would highlight in the coming slides. Number one is the omni-channel model. Almost 32% of the sales of Ethos are generated through online leads, and these sales through online leads have grown at a 50% CAGR for the company. This not only expands the market for Ethos, but also helps us in servicing a larger market with a lower store footprint, which automatically helps in increasing the EBITDA margins and the inventory turnover. It is important to note that while these sales are generated, that the leads are generated online, most of the servicing of the customers happens at the store level. So typically what happens is that a customer browses through the Ethos store, goes through all the models, and if he likes few of the models, he can get in touch with a call center wherein our watch experts are available for the customers to talk to, who can explain them about each watch, its legacy, its history, about the model. And if the customer selects any particular model or 3 4 models, one of our executives can actually go to the residence of the customer to showcase the model, wherein he can finally pick one of the 3 4 shortlisted models, or the customer can be directed to the nearest store in the vicinity to complete the transaction. Also, we can see the impact of this on the numbers, wherein the front end rent and manpower cost has decreased from 13.7% to 10% of revenues, in line with the increase in the sales generated from online. Also, the inventory turnover for Ethos has improved significantly from almost 10 months in FY11 to less than 8 months in FY18. Going forward, the management is targeting an inventory turnover of 6 months. A combination of improvement in margin and improvement in turnover is expected to increase the return on capital for Ethos from current 10% to almost 20% in the next 3 to 4 years. Another exciting thing about the ethos is the strong digital asset which we have created, which is vindicated by some of the statistics of Ethos website. Globally, Ethos ranks 61,000 compared to uh, compared to a Chrono 24, which is again a marketplace for luxury watches globally, whose rank is around 2,42,000. In India, Ethos is ranked 5,500. This is all from Alexa. Also, in terms of engagement, we can see that daily page views per visit in Ethos is almost 4 compared to 3 for Chrono, and daily time spent on the website is almost 5 minutes for Ethos compared to Chrono, which is almost half of Ethos. Uh, by the way, Chrono is generates almost $1 billion of transactions across the globe for luxury watches. We believe that Ethos has created a unique digital asset, and as the market for India expands in the future, Ethos will benefit disproportionately because of a combination of the largest physical presence combined with the best in class digital asset. Another unique strategy of Ethos has been to tie up with Swiss brands on an exclusive basis, wherein the brand is retailed exclusively by Ethos or 2 or 3 other retailers only in India. These arrangements offer the benefit of better margins to Ethos. At the same time, for as of today, the margins on these can be as high as 35 to 40% compared to 22 to 24% on non-exclusive brands. The sales from exclusive brands for Ethos have grown from 3% in FY16 to almost 17% of the sales as of calendar year 2018. And the company plans to take this contribution to 25% of the sales in the next few years. Some of the brands with which we have exclusive arrangements are Oris, Raymond V, Calif, Bucherer, Teutoni, Coram. One of the most successful case study for exclusive brand for Ethos has been Oris. This brand was present in India uh, for the last more than 10 years, and originally the brand had a subsidiary in India which was distributing to all the retailers. However, it found it difficult to manage all these multiple relationships within India because of the fragmented nature of the market, and they were unable to make a meaningful dent in the market. And around 2 years back, Ethos approached Oris to tie up with them on an exclusive basis, wherein they would sell only through Ethos and gain access to almost 40 plus stores of Ethos instantaneously. And This is what happened. And once we signed up Oris on an exclusive basis, they terminated all the relationships with other retailers, and Ethos invested significantly in digital marketing for the brand. And today it is one of the best performing exclusive brand for Ethos. And it has also opened a mono boutique store, which exclusively retails only Oris, which is generally the mono boutique stores are meant for the brands with extremely high customer pull like Rolex, Omega, Rado. But KDDL has opened the store for Oris as well, which indicates the successful scale up of the brand within India. And we believe that going forward, as we the value proposition becomes more compelling, more and more brands in of from Switzerland who are unable to scale up in India will look forward to tying up with someone like Ethos, which can give them instantaneous access to 45 stores across India, combined with a strong digital marketing capability. And therefore, we believe that this particular strategy is one of the unique aspects of Ethos compared to all its competitors, and is expected to not just drive the growth for the business, but also more importantly the gross margins, as the margins on these brands is almost twice compared to other brands. This is because here we are able to capture both the distribution and retail margins. Also, we can see that the impact of this strategy on margins, we have seen that from FY17 to December 18, there has been a strong uptick in the gross margins for Ethos from 22% to 27%, and EBITDA margins have also gone up from 2% to 6%. It is important to note that between 15 and 17, the margins were on a decreasing trajectory because of the disruption in the marketplace because of regulatory reasons, which led to a slowdown in the demand. Also, Ethos is looking to launch a pre-owned watch business, which is a reasonably big business globally. And if this business is successful, this can add another element of growth and profitability for the business. As of now, not we are not capturing any of the projections in our projections, the business for pre-owned watches for Ethos. Key financials of Ethos as of FY18 ending March, the total operating revenues is around $51 million. This is the net revenue, which is after taxes. The gross billings for Ethos as of today stands at around $70 million. The EBITDA margins is around 5%, which the management wants to take it to 10%. And the profit after taxes at around $1 million, which is negligible. We believe that this business still is subscale and is in an investment phase where most of the stores are still not mature. And in the next 3 to 4 years, we believe a combination of strong omni-channel strategy combined with exclusive brand strategy, the business will grow at 15 to 20%. At the same time, the margins are expected to inch up to 8 to 9%, and the return on capital, which currently stands at around 11% for Ethos, is expected to reach to 20%, driven primarily by increase in the margins and decrease in the inventory days. Also, the management of KDDL has announced its plan to unlock the value of retail business by spinning it off and listing it separately. We believe this is in the best interest of the shareholders, as well-managed retail businesses in India command significant premium to the overall market, with some of them trading at almost 3 to 4 times enterprise value to revenues. We have shown a list of retail companies in India which have more than 10% ROCE, and we can see that the median multiple for the retailers is around 1.7 times, while at the higher end, the multiple can go to as high as 4.5 times revenues. Price to earning is not very relevant to look at in India because most of these retailers are in a growth phase and are still subscale. Therefore, the profitability is not reached maturity yet. In terms of future projections for Ethos, we believe that Ethos can grow at around 17% in our base case and in bull case at 25% to reach revenues of around 115 to 150 million dollars in the next 4 years. This is going to be a combination of market growth and also market share gains. Applying a multiple of 2 times, which is a premium to the industry median of 1.7, the premium is justified because Ethos is the market leader within its category and is already by a wide margin, and the return ratios of Ethos will inch up significantly from current 10% ROCE to 20%, which will help in getting a better multiple. Therefore, we believe 2 times EV by revenues is a fair multiple to give. Accordingly, Ethos could be worth $200 million in the next 4 years. KDDL owns 73.3% of this business. Therefore, the value of KDDL's holding in Ethos would be $150 million in our base case. For the standalone business, which is currently doing a profit after tax of $2.2 million, we are projecting that the profits will grow in line with the revenues at around 15% in the base case, and therefore this business should do a $4 million profit in calendar year 2022, and giving a multiple of 15 times, this business could be worth 58 to 60 million dollars in the base case. And combining the value of these two businesses, the overall value of KDDL comes to around $207 million in our base case, of which 150 comes from Ethos and 58 comes from manufacturing business. This compares with current market cap of only $70 million, which means that we believe that KDDL could be worth more than 3 times in the next 4 years. Key risk factors would be: number one, holding company discount if Ethos is not spun off, inability to scale up Ethos because of either lack of capital going forward or any change threat from online retail, brand setting up their own stores, threat of smart watches, which we believe is not a very big threat because luxury watch has a different customer category segment, frequent dilution of equity. Historically, KDDL has done a lot of dilution in order to fund the growth in the retail business, and we believe that it has been a prudent step because raising equity to fund the business entails lower financial risk in case of severe downturn in the business, as we saw in 17 and 18. Overall, I would like to say that KDDL is overall a bet on the global Swiss watch industry with respect to its manufacturing business, and for the retail business, it's a bet on the consumption boom which is expected to happen in India. And the combination of these two, combined with market leadership in India and a strong value proposition in the manufacturing business, means that the business can be worth more than 3 to 4 times in the next 4 years compared to current valuations. I would like to invite any questions and would be happy to answer. Thank you.
Lalaram, thank you so much for such an in-depth presentation. We are out of time right now, but I would encourage our members to feel free to follow up with you directly with their own thoughts or questions. We would be happy to facilitate an introduction. Once again, thank you so much for taking the time to be here and share your investment thesis with our members.
Thanks, Sean. It was a pleasure.
Goodbye for now.
Bye.